Hey traders and investors, it's Serge Berger here. Today I want to talk about a pattern that is extremely important to understand, again, particularly in the context of the current market where we've seen this very sharp V-shaped reversal over the past week and a half or so. That really has to do with the lower lows that we've put in a lot of the sectors and different indices. So the best example I can give you at the moment is the S&P 500 industrials sector ETF, the XLI. And you can see if we peel back a little bit on this chart, it doesn't take a massively detailed analysis to see that the breakdown that we saw here in October, first half October and in the latter part of September actually has caused pretty good damage. If you look at this from a point of view of just simple volatility, you can see this V-shaped reversal basically is unlike anything else we've seen here in a long time, just from a pure up, down, and up move. Even when we fell off a cliff here in 2011, we didn't just bounce back that sharply. This actually, more than anything, in terms of volatility, is sort of more something in 2009, but at completely different levels after a 5-year bull market. So, what's important to understand now in this respect is that considering where we are, that basically we've seen a big topping pattern. It's from a purely technical point of view, it's unrealistic to expect a market to start a major next up leg after breaking to lower lows in the sense of the time of the helping of volatility in which it came. Okay, so a lot of chartists are now and other guys are looking at this and say, okay, trend line here, lateral resistance you can draw, trend lines in 1,000 different ways. Well, this is going to go higher. Well, first of all, this move here has just been way too exhaustive. You can look at various different momentum indicators, and just common sense will tell you that yes, ultimately we likely will push above here and go higher, but in the sort of immediate to near term, even if we get a breakout higher, what this type of a pattern needs to do is a little bit something like consolidating and then maybe go higher, or maybe just consolidate more, and then ultimately go higher. However, and that's sort of the best case. What's important to understand here is that the index, after topping out, basically not being able to make meaningful or sustainable new highs since June, then ended up actually breaking below a pretty key support area, making a lower low. Yes, that lower low got rejected, but because we had a lower low, it's then very unlikely to right away start a brand new up leg. Yes, if we would have had some sort of major sell-off that lasted months in the context of a big secular bear market, or even a cyclical bear market, then that would be different. But in this case, we're still operating within the context of a broken sort of medium to longer term chart that has a topping pattern. So a break to new lows, to lower lows, does not immediately lead to a breakout or a sustainable breakout to higher highs. I hope this makes sense. I know it's a bit of a mouthful, but it's an extremely important sort of pattern from a period technical point of view to keep in mind, particularly in the current market. I hope this makes sense. As always, if you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.